Shareholders of Duolingo, myself included, have had a very rough year. Shares traded for over $500 per share, and the popular language learning app reported earnings after the market closed today. Wall Street did not like what it heard, sending shares down by as much as 15%. So what happened during the quarter? What am I going to be doing with my own shares, and what does valuation look like? My name is Brian Stoffel. As I said, at the time of this recording, I do own shares of Duolingo. And I want to give a shout out to Fiscal AI for sponsoring today's video. You're going to see me using this a whole bunch. So this was Duolingo's first quarter of 2026. When the market opens tomorrow, it'll be somewhere between a $4 and a $5 billion company. Now, if we just look at the headline numbers, you'd think this was a pretty good quarter. Revenue is up 26%. That beat analyst estimates. It beat the midpoint of management's guidance. So far, so good. Instead of earnings per share, I actually looked at operating income because I think it does a better job of telling the story of the underlying business. And operating income grew by 88% and came in way ahead of analyst estimates. So far, so good. On margins, it looked pretty good here as well. Gross margins expanded to 73%. Operating margins pretty much went up by 50% to 15.2. Net margins were down slightly. I don't really care too much about that. Free cash flow expanded meaningfully up to $148 million. The free cash flow margin was over 50%. 50% of dollars they collect converted to free cash flow. Net income was up slightly. Stellar balance sheet. The company also repurchased about 500,000 shares during the quarter as well. If we look down, you might again say, I don't understand what's going on here. Why is the stock down? Because look at this. Revenue up 26%. The cost of that revenue only up 18%. When this grows faster than this, that's a great thing. It leads to this. Gross profit growing even faster. That is operating leverage. Look at this. Operating expenses only up 20%. Research and development went up. Sales and marketing went up. General administrative just barely, but less than revenue did. And that is how the company pulled this off. 89% growth in operating income. So far, this looks like a pretty good quarter. But now we have to go on over to Fiscal AI to look and see underneath the hood. Now, this is a tool that I use every day. And I think if you want to become a better individual investor, you should too. Click the top link in the show notes below, and it'll take you right to Fiscal AI. So what I've done here, the first thing that I pulled up under the financials tab, and then down here under segments and KPIs, is all the different revenue streams that Duolingo has. Now, this top one is what we associate the most with Duolingo. It's just their subscription revenue. You get a max plan, you get a family plan. This is the revenue that comes from that. Down below that is advertising, because remember, this is a freemium model. Below that is the English language test revenue, and below that are in-app purchases. Now, obviously, the revenue from their subscriptions are the most important. And if we look at that, you kind of see a little bit about what people are worried about. Because while it was understandable that the revenue growth rate for this came down when society opened up after the pandemic, it re-accelerated up to 53% growth in early 2024. And it was still at 46% growth just last fall. Let me say that again. It was still at 46% growth just last fall. It is now at 31% growth, which isn't bad, but it's not what it used to be. So that is the subscription revenue. What about advertising? Because remember, this is how they are able to monetize all of those free users that they have. Advertising revenue, it fell by quite a bit. And it was at 55% growth last summer, was at 42%, then just down to 15%. Now, the company has made it very clear that they are making a transition where they're trying to make the user experience on the free tier better and better and better. It's possible that by doing that, they are showing fewer ads. I wasn't able to catch any real commentary on that during the conference call. If we look at the Duolingo English language test, that's been negative for quite some time. It's not a huge revenue driver. I don't think it's that big of a deal. It is worth pointing out that these in-app purchases, if you take them as a metric for a level of engagement, were down. They were growing 18%. It's not the first time they've been down. It was down 11%. So that's some of the inside baseball. But when we come to this next frame, this is really what's happening here. First thing that I pulled up here are monthly active users. So whether you pay for Duolingo or not, if you go in at least once per month, there were 138 million people that were doing that. And here's the thing. That 138 million is more than the 130 million from the same time last year, but it's only 6% more. And here's why that matters. Again, as early as the beginning of last year, in the year-ago quarter, their daily active users were growing 33%. And we know that their social media numbers and their ability to recruit via social media and word of mouth has really taken a hit for whatever that reason is. And we see that that growth rate has really slowed. Now, management downplayed this. They said they're not focused on monthly active users. They're focused on daily active users. I push back against that a little bit because when you're focused on top of funnel, you got to grow both, because they said we are going to pivot away from focusing on monetization, and we're going to pivot towards growing the number of free users we have. Well, it's not shown up yet. It's not to say that it won't, but it's not shown up yet. Let's look at the one that management does look at a bunch, which is daily active users. Now here, it grew much better, 21%. That's much better than the 6%. So the percentage of monthly active users that are daily active users is going up. And we know that because the numerator is growing faster than the denominator. That being said, we can understand why there is some reticence. 48% growth of daily active users 1 year ago. 2 years ago, 55%. 3 years ago, we were at 62%. Now, of course, they can't keep growing at that rate forever. That's no surprise. What is a surprise is that this growth rate got more than cut in half, which wasn't the case before. When you go from 55 to 48, that's not getting cut in half. When you go from 63 to 54, that's not getting cut in half. When you go from a 48% growth rate to a 21% growth rate, that's more than cut in half. And it makes people worried about where the company is going. So how do we figure out where the company is going? Well, first, we can look at the number of paid subscribers that the company has. And again, this grew at 21%, which is great. However, during the year-ago quarter, it was 39%. So that's just under that growth rate being cut in half. But that wasn't the case before because it went from 54 to 39. That's not being cut in half. And before that, it was going from 65 to 54. That's not being, the growth is not as durable as it seemed to be before. That said, 21% is not bad. But the question I asked before was, how do we get an insight into what's going to come around the corner? And that's where we turn towards bookings. Now, bookings can be a little bit confusing, so let me explain this concept here. Imagine you go to the state fair and you want to ride on some of the rides that they have there. Usually you don't give your dollars or put your credit card up to the person who's running the ride. They've got other things to focus on. What you do is you go to a little booth and you pay for tickets. And so the money's been collected, and then you use the tickets and redeem them for a ride. When you pay for those tickets, that's like bookings. It's not that different than revenue when you think about it this way, because the company has the money in hand. But they don't get to count it as revenue until you turn that ticket in and ride the game. Or you use Duolingo this month or next month or what have you. So bookings really is an important way of looking at what's coming around the corner. And this is where the problems really start to surface. Because if I pull back this dial right here, if you look from March of 2022 to March of 2025, bookings never grew slower than 40%. They got down to 40% in 2023, and then they reaccelerated. And this looked like a durable growth story. Look at going from 78 million to 100 million in the holiday quarter, going from 121 to 158, 176 to 237. This is impressive growth. But now let me pull this forward to the present day. And you can see what has happened, because this 45% growth rate that we had before went all the way down to 15%. And that's for subscription bookings. If we look at overall bookings, here's what we see. We see that it's even worse. And it came in at 14%. Now, when management released their earnings for the fourth quarter, they forecast bookings growth of 11%. Now, I looked at this and I said, oh, this is actually good news. It means it's not slowing down as much as people thought. They said 11%. It came in at 13.6%. That might seem like a small deal, but when it gives more credence to management's commentary that they're pivoting and that they can make this pivot and that it will resonate with their consumers, it has a problem though. And that is that on a constant currency basis, because Duolingo collects more than half of their revenue outside the United States. A lot of people use it to learn English. When you look outside the United States, that constant currency, it changes things. And their bookings growth actually came in at 9%. So let me say that again. Bookings were forecast for 11%. They came in at 9% on a constant currency basis. And not only that, but those growth rates were revised downwards. Management said that bookings are going to come in at about 6% in the second quarter. So just to put that in perspective, we're talking about going from 41% to 6%. Now, yes, management did say that this was the obvious pivot that they're going to be making. But at the same time, they're lowering their guidance significantly and still not able to hit those numbers, which is a problem. Management did adjust the bookings and their revenue downwards. So instead of 11% for the full year, they said for Q1 and the full year, they're now saying 10.5%. That's not great because it came in at 13.6%. Now, they said they expect it will reaccelerate in the second half of the year, but it's hard to take management at their word and their ability to forecast this if they are offering lowered guidance before and they're not hitting those numbers. So that's that story. Now, on the flip side, it is worth pointing out that Duolingo does have an excellent history of converting their monthly active users to paid users. So you see that way back when the pandemic started, if there was 100 free users of Duolingo, only 3 were paying users. But we are all the way up to 9. It has tripled its percentage, and that's great. But management has said we're not focused on monthly active users. We're focused on daily active users. And converting them to paid users it's pretty much been a flat line, which means that they're both growing at roughly the same rate. So nothing too good or too bad when it comes to that. So that's what was going on during the quarter. When management released their guidance, they called for revenue growth of about 17%, which pretty much is right in line with what analysts were expecting. Their earnings guidance, they said their adjusted EBITDA will shrink by 10%. Now, there's a lot of puts and takes in there between adjusted EBITDA and operating profit. But the bottom line is both analysts and management expect profitability to fall. They do expect gross margins to fall, which brings me to my next one, which is what am I, as a shareholder myself, going to be watching? The first are those constant currency bookings. It really hurts to be growing 30%, 40% plus for a long time, then guide to 11% growth and not hit that 11% growth. That's not great. So they better be able to hit that 6% bookings growth in the second quarter. I know this is about the pivot, but you got to be able to show people that you can trust what you're telling them. Number 2 is daily active users. 20% growth is pretty good. We'd like to see that number continue to grow. And I'm willing to give them a pass on the monthly active users if they continue growing those daily active users. Third, guidance for full year bookings, because we've had downward revisions, and that's not great. And fourth, total paid users. Want to see that continue to grow at least as fast as daily active users. That would be a really great sign. Management talked a bunch about how they're really focusing on the spoken word and integrating that into all their lessons so that people can learn to speak new languages. Overall, the mode is uncertain at best. The thesis is uncertain at best. Look, I think that they're doing the things that they probably should be doing. I think that they got caught off guard by this slowdown in their word of mouth virality, and that's not great. That's really, really not great. So the last piece that you wonder about is then valuation, because as I'm going to show you in just a second, while this was not a totally clean or even a really great earnings, the valuation is still pretty compelling. Now, before I get to that, I want to let you know I have tracked my own results over 10 plus years. My results are in the green ahead of the NASDAQ composite, and all the way down there is the S&P 500. And I mentioned that because my program, Stock Investing Mentor, is available, and there are 3 parts to it. One is a weekly live 1-hour training session every Thursday at noon Eastern that is recorded if you can't make it. Number 2 is full real-time access to my portfolio with updates on all the stocks as I make any changes. And 3, 24/7 access to a private online investing community. But there's a 4th part that you get if you sign up for Stock Investing Mentor today, and that is our Stock Simplifier 2.0. This is a brand new tool that has not been released to the public yet, but if you sign up for a subscription to Stock Investing Mentor, you will be able to use this tool to your heart's content. Now, just to give you an idea of some of the things that Stock Simplifier can do, it gives you a breakdown of revenue. It lets you know about the business quality. You can get a deeper analysis. You get to make your own ratings. You get to go through and say, well, what stage of the business growth cycle is it in? You get to find out about the company's moat and what you think of the moat. You get to find out about the company's growth potential and what we might think of the growth potential. So if you would like that, simply click the second link in the show notes below. This is a $200 to $300 value that you get absolutely free with a subscription to Stock Investing Mentor. And if you click that top link, not only will you get that for free, but you'll get 10% off of an annual membership. So let's go to Duolingo's valuation. Right now, it is trailing for just 13 times trailing earnings. That is cheap on an absolute basis. It is also cheap relative to the company's own history. If we look at their price to free cash flow, it gets a little bit different. Different in so much as it's still trading for about the same thing, but its history was a little bit less severe. Again, definitely cheap on an absolute basis, definitely cheap on a relative basis. But as you might have suspected, people are mostly worried about what's happening looking forward. And Duolingo, if we look at it on a forward PE, well, all of a sudden, the story changes quite a bit because they are expected to see revenue and they're expected to see margins get compressed quite a bit, which is why even though it's trading for just 12 times forward earnings, 12 times trailing earnings, it's trading for 38 times forward earnings. That looks a lot less cheap. What about price to free cash flow? This looks a little bit better, trading at about 14 to 15 times forward free cash flow. Seems like a pretty decent deal. Of course, you should know by now that what really matters to me is if we do a reverse discounted cash flow analysis. So what I'm going to do over here is I'm going to go over to my calculator and put in our ticker symbol. Now, we could go and say, what should we consider the optimized free cash flow margins to be in the future? Now, I'm going to build in a bear case because I like a margin of safety. Right now, they have a 38% free cash flow margin. They are printing money. There's no doubt about that. But you saw with the bookings that this is headed in a direction that's not so great. So let's assume that they just hit 30% free cash flow margins in the future. So we're actually going to lower the free cash flow that we put in there. So if I pull this up, you can see right here that they've got $1.1 billion in trailing revenue. Now, $1.1 billion in trailing revenue at a 30% free cash flow margin is $330 million. So let's go ahead and put that in. Now, I'm going to be conservative and give them just a 2% growth rate, a 10 terminal growth rate, a 10% discount rate. So now we're solving for the revenue growth that Duolingo needs. And as you'll see, it's pretty low. They're saying if Duolingo can hit a 30% free cash flow margin, it only needs to grow its revenue by about 5% per year moving forward to make this work. Here's the problem. Bookings are only expected to grow 6% in the second quarter. If they can pivot, like management is talking about, you better believe this is going to be an amazing, amazing steal of a stock. If they can't pivot, well, then that's a different story. And using Fiscal AI, we can go over and see, well, what have they been doing versus these estimates in the past? And in fact, actually, before I do that, we can actually look at what are the estimates moving forward. So if we go on over here, I'll go back to this. Remember, 5%, that's all we need. 5% revenue growth. Can they get it? I'm going to pull up their revenue growth over the last couple of years. And you can see it's still at 36% right now, but what's expected? And what's expected is 16, 14, 12. Again, not great, but it's 2 to 3 times faster than 5%. And I realize it's just 3 years out of 10, but still. All right, now let's see. Can we trust those numbers? Can we trust them? Let's go and look at the estimates and how they've changed over time. And the fact of the matter is, it's a mixed bag. Now, when the company reported in 2024, it is true that estimates kept moving up. And in 2025, estimates by and large kept moving up. But for this year, it's been a different story. Because at one point, the estimate was that Duolingo this year, 2026, would do $1.3 billion in revenue. And now that's down to 1.2. Not a huge difference, but heading in the wrong direction. But look at next year. When people started to guess, what will this company get in revenue in 2027, they started out by saying 1.5 billion. They're down to 1.38 billion. So that's not a great move. So the bottom line when it comes to Duolingo is the simple fact that clearly it is having trouble earning investors' respect because they are trying to pivot. And whether or not they can pull this off has been called into question. At the same time, the valuation is such that if they can make that pivot, well, then it's going to be a pretty great stock to own. But we haven't seen any definitive signs that they're going to do that yet. They need those monthly active users to grow. They need those daily active users to grow. And they can't move fast enough on this. So, what am I going to be doing with my shares? That's something that I share with members of Stock Investing Mentor. If you have your own opinions on Duolingo, share them in the comment section below. Don't forget to hit subscribe the next time that I talk about Duolingo in 90 days. And until then, Brian